Welcome back to Stock Market Weekly, your 20-minute show catching you up on all of the notable moves across financial markets. And there are lots to take note of this week. I'm your host, Evan Medeiros. We publish these shows every Friday, so make sure you are subscribed to the channel and check back in so you're prepared for the week ahead. Now, there are plenty of weeks out there in the stock market where things are very status quo. We are sort of just following or meandering along the existing and prevailing trends in the stock market. And then there are those few select weeks where notable transition or potential trend changes happen. And I think that is one that we got this week, a week to take notice. It really started with Jerome Powell. We had the Fed out on Wednesday, largely anticipated a 25 basis point cut. We did get that. However, during the press conference following, Jerome Powell came out with a lot more sort of hawkish, hesitant stance to basically cut further into next year. So he was a lot more cautious on rate cuts. And that was something the market was not expecting. We saw the dollar index break out to new high levels, reminding you, of course, now that the dollar index is up approximately 9% over the past, call it 2 months, which is an extremely fast and sharp move. And we saw interest rates continue to tick up. We saw volatility, the VIX, put in its second largest percentage move day ever in its history. So we basically had a full out sort of calamity here that the market was not expecting on a sleepy sort of end of year time period. We saw equity markets sell off aggressively, close on some of the largest down sessions of the year, and lots of sort of turmoil in the markets. Now, we did get a little bit of a breather here, a little bit of some stabilization into the end of the week, but it's not exactly full on rosy colored glasses here. I think there's lots of, data to chew on here, and we're going to analyze that in this video. We also have now a government shutdown that is looming, and that is adding a little bit more tension here into the already sensitive mix of what the market is trying to just get through the end of the year with. So lots to talk about. Stick around. Let's get into it. All right, here we go. We've got some charts in front of us. Warden TC2000, that is a charting platform we're using. It's a platform we support here at the Trade Risk. We've got lots of cool things built for it. I also program custom indicators, scans, layouts for traders of the platform. So if you're interested, check out some of the links we have in the description of this video and some of the guides and tutorials on thetraderisk.com. Let's get into the numbers here. You can see 1 week returns firmly in the red across the board here. 2% was the best performing, and that was the S&P 500. 2% to the downside, negative 2%. That was the best performing of the major US indices. Russell 2000 down almost 5% this week. Now, volatility was the star, and it certainly, came off of its highs. Thank the Lord here for that, because we would be going out with some very, very elevated, scary levels of volatility. We were up basically 4 and 5 points here for Nasdaq vol and the S&P. S&P going in to the weekend here at 18.36. Nasdaq vol back above 20. Now, if we take a look at our sector overview here, everything in the red, nothing green. Technology tried to hold up, sort of best in class, still kind of holding on to that theme here. We saw technology emerge as sort of the leadership group here over the last few weeks, fueled mostly by the Mag 7. And that actually held in this week. I mean, minus 1.29% wasn't so bad. Utilities and financials were also the second and third spot in terms of relative performance. On the downside, it was energy, it was real estate and materials, all slammed basically 4 to 5.5%. If we take a look here also at the 1 month returns, you can see that pretty much every sector now is negative over the past 1 month of trading, except for technology, still up 2%, and consumer discretionary, thanks primarily to Tesla, Amazon there, and communication services eking out a small gain. Now, if we go to our sector trends here, things are looking a lot more bleak. We are getting a lot more sell signals that are either accelerating lower or have freshly sort of generated. The communication services sector finally rolled over on Friday, so that had been holding out as a relative strength pocket. Notice technology still hasn't rolled over, neither has discretionary, but basically everything else has produced a sell signal here. This is our smart trend filter indicator. It measures price, volume, spanning across time, and has some price action filters or relationships to curate the signals here. Everything had been kind of in its rollover state, either coming into this week. Some of these sector ETFs have already broken down last week, but everything else now is in the red. So if we take a look here at market breadth and we get a little more granular, we were talking about this last week. It's our favorite thing to look at, simply 52-week highs, 52-week lows. And you can see that we had a sharp expansion of the number of stocks hitting 52-week lows on Fed day. You can see this big volume spike right in here. If I zoom out, it's pretty much the heaviest or the sharpest volume, selling volume is perhaps not the right word, but the most intensity of number of stocks hitting 52-week lows that we've seen all year long. So, even when we go back to the July, August kind of spout here that the market threw, you could see that even then breadth didn't get that bad in terms of 52-week lows. This though, getting up there, inching up, not quite where we were back in the bear markets of the former years here, but certainly a noticeable uptick here. An uptick that's enough to kind of say, okay, this has definitively sort of shifted the landscape a little bit. And you can see, of course, on the top screen here, the number of 52-week highs has certainly dried up. So this to me now puts me in a much more pessimistic, at best neutral outlook here, but certainly kind of a glass half empty. And we're going to need to see, the market stabilize here before we really want to be, stepping on the gas in terms of risk. Now, if we take a quick pit stop here, we look at Investors Business Daily. They are a sponsor of the show, so thank you, IBD. Shout out to them. We've got links in the description of this video. This is their IBD 50, top 10 on their IBD 50. You can see they had one big standout winner here, which was DOCS, D-O-C-S. Everything else kind of mixed or, kind of taking its lumps along with the market. But you can curate this IBD 50 list every single week. Grab your subscription in the description of this show. Grab your subscription in the description of this show, tongue twister, below. Now, let's get on to our macro slide. This is where things really start to get concerning. If we take a look at the dollar index here in the top right, you can see that we got a fresh breakout here. And this is, really starting to extend to some, very nosebleed kind of levels. And the pace at which the dollar is rising is really going to be sort of concerning here for really the economy worldwide. You have lots of other nations that are perhaps in an easing state. We've got the US now, which is kind of stabilizing things. And this is going to be a very difficult spot here, I'd say, for the dollar to kind of soften, to get the dollar to soften. And this is going to start to put a lot of pressure on lots of different areas of the market. Now, the 10-year Treasury yield, bottom right, you can see also broke out to new highs here. So it ended up putting in a higher low. And now here we go, making new cycle highs here. We're not quite back to the 2023 highs, but we're definitely getting, again, just more pressure put on lots of different areas of the market with interest rates continuing to rise. If we take a look at our commodities down here, you can see gold was down 1%, oil 1.5% down, copper down, silver down, Bitcoin down 5.3%. So pretty tough week there for commodities. Let's get into, actually I want to show, let's see, I'm going to hit pause here. Let me bring up a layout. Yeah, so I put this layout together here right before the show. And we're a little bit out of order here, but I'll just stick it in now because I don't want to forget about it. And this is a market internals, market breadth screen. And this is showing the percentage of Nasdaq stocks, percentage of Russell 2000 stocks, and the percentage of S&P 500 stocks at 1 month lows. Don't mind this typo on the Russell 2000. This is showing the percentage of stocks at 1 month lows. And what you can see here on Wednesday is we basically got, in the Russell 2000's case, over 60% of stocks were making 1 month lows. It's, a short term or a medium term measure of market breadth or, sentiment, I guess, is another way to think of it, but really just market breadth. And you can see that this is kind of a washout sort of reading here. You notice you don't often get 60% plus of stocks all at the same time making new 1 month lows. If we take a look at the top pane here, S&P 500, closer to 70%. So again, some pretty good washout readings. The Nasdaq, again, did hold up the best. A little over 50% of stocks made 1 month lows on Wednesday. And so, I guess if I were to think to be a short or medium term contrarian here, this is subtly a good sign that you're getting a little bit of washout, that you're finally getting a little bit of the froth to sort of exit the market. It's been, a lot of kind of bulled up rhetoric for stock market investors, us included. There's just been lots of good things to sort of celebrate on why the market is going up. And so now you're starting to get that reset a little bit, and you're starting to get a little bit of washout in sentiment. And so that, if you're a contrarian, short term, can lead to some at least bounce plays or some short term opportunities on the long side. But what you have to be careful of is, which we're about to get into, is these also can mark a little bit of a regime shift, right? Let's get into some charts here. So if we kick it off here with the old S&P 500 weekly chart, this week's action, again, you can see closed off of the lows, but we were still down 2.16%. Now, I want to draw your attention to volume. This is dollar volume that I'm using at the bottom of my chart. And if I just zoom out here, you can clearly see that this week was the heaviest dollar volume traded week going all the way back to 2023 in sort of the depths of the bear market, or just about the recovery of the bear market process. So this was a very significant week of trading here, and it's coming after a prolonged uptrend, and it's coming after, if I zoom in on a daily chart, this little consolidation that we talked about last week and how it could be a nice continuation pattern brewing, but that definitely was not the case, right? We got a tight 2 weeks of trading. We had this nice doji day to set us up on Tuesday, and then the floor just completely fell out of the market. And we saw a 3% down session for the S&P 500, which basically was the worst day of the year. And we saw just some more turbulence here into the end of the week. So this here, to me, is ringing some alarm bells on such heavy volume and expansion in rain, taking out multiple weeks prior lows. This feels like a thrust of a trajectory that is changing now, which is different than what we've been in. Now, follow through is going to be key, right? None of us, I don't have a crystal ball here. So we're going to need to see how the market follows this up next week. If we can, entirely stabilize here, if we don't come and jeopardize the lows from Friday, and we can hang in here and start to constructively move sideways and work this off without more selling, without more downward pressure, then maybe that is it. Maybe we had one good kind of kick down, washed out sentiment, and that was all we needed to really sort of, reset the table, so to speak. But, I still want to be pretty cautious here on what this dollar volume and what this change of trajectory could mean here for a multi-week pullback in the stock market. I think that we do have this stage set now for the S&P to perhaps pull back in a more meaningful corrective state. I don't think it's going to be the end of the world. I'm not calling for anything crazy or significant. Call it a garden variety 8 to 10% pullback here in the S&P 500. I think the door is open for it. Whether or not, right, the market wants to walk through it, we're going to continue to do these videos once a week, and we'll measure and map it as we go. But it seems like we have some room here to perhaps continue to trade lower. We didn't quite fill the gap back here from the election. We got pretty close. We got into the gap on the morning, but buyers kind of stepped right in and drove us up. So we have a little more gap work. We could kind of come back in. We've got this big important 564 area here that was the prior high from July that the market could come test. And you can see that we did sort of lose this high here from October. So I don't have, I should have prepped the percentage pullback levels here, but let's just say we did get a 10% pullback in the S&P 500. That would basically bring us back down to about 550 here in the S&P 500, pretty much where we were back in September and August timeframe, kind of chopping around in this range. So don't forget, the S&P 500 is up 24% as of right now, year to date. So without any meaningful correction, right? 10% corrections are kind of table stakes, especially in bull markets. You can still get them fairly, routinely once or twice a year, 3 times a year. And we're sort of overdue. And I think this could be the start to it. Now, if it isn't, and we do manage to consolidate here in perhaps, contain it, call it 6% drawdown, and we kind of chop sideways for a couple of weeks, that might be the path the market takes. Get to Inauguration Day, see what the new policies are, see how everything's shaping up in terms of executive orders, and then, kind of play things out into early next year. So that's kind of, to me, it feels like the stage is set for a deeper pullback. We'll see if we get it, one day at a time. We're a little bit oversold in the short term. So that could mean that, we have a bounce or two into, holiday time next week, put in some type of lower high below or around 600, and then make a second leg down starting next year, right? Something like that seems like a reasonable path forward here. Again, it's not meant to be a crystal ball. It's just to keep an open mind. Nasdaq 100, is definitely still the best looking here. It really, collected itself over the past handful of weeks. I think for the Nasdaq 100, this big level here around, call it 505, which is approximately the July highs, we're still above it. And so if you're a longer term, intermediate term trader, our long-term trend following system, it's still in here. It's still engaged in the cues. Because it's a long-term trend following system. If you zoom out here, this long-term trend is still very much up, right? So there's no reason to exit now for that time frame. But if you're short-term, if you're tactical, if you're active, then there's probably some more risk management decisions, more opportunities for you in this very short term. So I still think we could, again, pull back here, just like the S&P 500. I think a little bit of a pullback across, all the averages here makes some sense, or at least is in the cards right now. And we'll see if we get it. But for now, we're a little bit stretched in the short term. Still, weekly chart shows heavy volume coming in here, and a little bit of a kind of a breach of at least last week's lows. Not quite as pronounced perhaps as the S&P 500, which lost multiple weeks of lows and the prior November high. Russell 2000 still looks a little bit different. Heavy volume traded this week, third week down in a row. Broke below our 225 level that we've been, kind of using as our line in the sand here for intermediate term strength. So the Russell 2000 is in the penalty box as well. Okay, it's done enough technical damage here. It looks definitely a little bit different than these other markets, but as long as it's below 225, I think this is in the penalty box as well. Okay, so changing of the guard here potentially, right? Expect some volatility in the short term. Maybe we can work this off sideways without too much technical damage, but it kind of feels like the market's setting itself up for a larger pullback. All right, so that is the major markets. Let's look at the VIX real quick. Take a look at this session here. So this was Wednesday. It was up 74%. I know it's a bit of a crime to express volatility in percentages. It was up 11 points, right? So it just, it's coming from a very subdued place, a 15 VIX going to basically a 26, 27 VIX. Actually, no, it's 28 at the highs. So that's a very impressive move. That tells you the market was caught off sides. It was triple witching this week, right? So we did have some other dynamics coming in here in terms of options expiration and how dealers are positioned and what they need to do to offload risk. So there were some interesting dynamics here that maybe sort of exaggerated some of the moves that we saw, but nevertheless, VIX up to 28, and then it did, lose 10 points into the close here around 18 or so, and we'll see how that follows up next week. Interest rates, 10-year Treasury bond, IEF here, you can see sliding back down, breaking to new lows. This is the inverse of 10-year Treasury yields, and you can see it's just comfortably kind of back in this old range, back to levels, lows really from middle of this year. TLT, same situation here, starting to break to new, kind of multi-month lows here, and starting to, look like it wants to kind of continue on this downtrend trajectory, at least for the time being. We really want to see interest rates here start to reverse course. We want to see these lows perhaps get faded, and we want to see a fast move up if we're going to start to, and that should coincide with a weaker dollar. That's, again, a best case scenario for the US stock market. Let's talk about Bitcoin here. So Bitcoin, earlier in the week, I was posting, Bitcoin over 100K, MicroStrategy over 400 bucks. This is where we can start to get some momentum to the upside. And we did. We had it for about 12 hours, and then it all completely reversed. The party ended. There was almost no party because it was so short-lived. MicroStrategy back below 400 bucks. Bitcoin back below 100K, parties canceled, momentum's gone. I think, for the first time in a while as well, Bitcoin could correct here, could have a little bit more of a meaningful correction, maybe down into the low 80s. Again, no crystal ball. We're going to take it one day at a time, but it just seems like risk has opened up a little bit across all these markets. A little too many failed attempts over 100K, and it seems like the market may want to just sort of punish either latecomers or perhaps, kind of shake the tree for some of the recent longs here to just kind of stir up the supply, stir up the traders, and a move, down into the 80s of some level seems like it's in the cards. Speaking of MicroStrategy, they did get included into the Nasdaq 100. That was really news last week. So this week, I think they started to get some of the flows positioned in here, but they are in the penalty box as well. They're going to trade pretty much like Bitcoin, just on some leverage. So, if Bitcoin's going down, you would expect MicroStrategy to go down as well. So I think that is just about everything I had for charts. Dollar index, I think we talked about that already, just going up and vertical. I think that's everything. I did update our trading. So I put out a note on Twitter on Wednesday. So for Wednesday, our biggest loss of the year across all our trading systems was on Wednesday, right? So on days where you get those big moves, you get kind of two different camps. You get the I told you so folks that, just want to dunk on potentially being right. And maybe, some of them are for good reason. They deserve their victory laps. But, a lot of traders got hit on Wednesday, right? And so we were one of them too. Our trading systems were net sellers this week. So we're taking down risk, had a total of 23 sells across our trading systems. We're still heavily exposed. That will start to change, I would imagine, next week. Our short-term system made a bunch more buys on Friday morning at the open. And so far, so good on those purchases, but this is going to flip out this exposure pretty darn quick. So I think we already have a bunch of sell orders lined up for Monday. So our short-term trading system is going to be taking down exposure pretty quick. Our medium-term trading system has been reducing exposure, but these things take time, right? Long-term trends, medium-term trends, they don't just break overnight. A discretionary trader can react to those trends a little bit quicker. Systematic rules-based systems like these, they're going to have to, they have to follow protocol, and they will end up, getting out. It's just we need to see the proof that the trends truly have changed on those longer-term timeframes, right? So that's currently how we're looking into next week. We've got all of our performance. We posted every single month, and you can check that out. And we have free trials available as well. So if you need some guidance here for the new year, if you want a systematic rules-based process, these are the signals that I follow myself, and this is where I manage all of my trading capital. All right. So tough week out there. Right? Lots of volatility, potential changing of the guard. I know it's a tough time to want to do homework during holiday season. This should be, an easier time, less volume, less trading, less staring at screens. But, you got to do your homework around these periods when the market's telling you some things might be changing. Remember, follow through is going to be key though, right? So this could all just be one quick washout and the market kind of shrugs it off and starts, resumes its trend higher, which is possible, or it's the start to that more corrective sort of state. So we'll be back next week. Merry Christmas, happy holidays, happy Hanukkah, all the good stuff. And, hopefully you get to enjoy some time away from these markets, as wild as they may be at this time. So thanks as always for tuning in. We'll see you back here next Friday. Take care. Have a great holiday.